Europe has finally had enough of China's deception, and the entire EU is now taking hard action.
Russia and China.
China and Russia.
Russia and China have.
Russian and Chinese leaders.
Russia and China have formed a lethally dangerous alliance.
The head of the CIA says the U.S. is confident China is considering providing lethal weapons to Russia.
The findings suggest further evidence of a flourishing new trade relationship between Russia and China.
China and Russia reaffirm their no-limits partnership. Building on already strong strategic and economic ties, could their alliance challenge Western dominance?
After years of watching China secretly funnel tech and financial lifelines to Russia, the EU is finally striking back. In a sweeping move that's part retaliation, part warning shot, Brussels just sanctioned several Chinese banks and companies. This is a clear message that China's silent support for Russia in the Ukraine war won't fly under the radar anymore. Naturally, China is causing a fuss, but its own top officials have even been caught admitting that they can't let Russia lose this war. So today, we dig into how China's secret support for Russia is unraveling its fake image of neutrality. From secret bank transactions to drone fragments stamped "Made in China." Let's dive into the evidence that has made Europe turn on China. To understand why the EU is taking such a hard line, we need to go back to how China and Russia became such close partners. It all started before the Ukraine conflict exploded in 2022. Just weeks before the Russian invasion, Chinese President Xi Jinping and Russian President Vladimir Putin declared a no-limits partnership. It was a bold statement, signed during a meeting in Beijing, that said their friendship had no boundaries and no off-limits areas for cooperation. And this wasn't just talk. It was a signal to the world that China and Russia are ready to stand together against Western pressure. Since then, their relationship has only gotten tighter, especially as the West piled sanctions on Russia. When those initial sanctions hit Russia, they hit it hard. They even cut off access to the global financial system SWIFT, which connects banks worldwide for international payments. Russia's economy was expected to take a nosedive, but it didn't collapse as quickly as many predicted. Why? Well, because China stepped in. Trade between China and Russia skyrocketed after 2022. In 2023 alone, bilateral trade hit $240 billion, a 26% increase from the previous year. Last year, that number went even higher, breaking the previous record. China became Russia's top trading partner, supplying everything from consumer goods to industrial equipment. While the West attempted to isolate Russia, China provided a lifeline. It began purchasing Russian oil and gas at discounted rates and selling back technology and components that Russia could no longer get elsewhere. China's role wasn't just about trade, though. It's been a delicate balancing act. On one hand, Beijing has claimed neutrality in the Ukraine conflict, even floating a 12-point peace plan in early 2023. The plan called for things like ceasefires and respect for national sovereignty. But it was vague and didn't explicitly condemn Russia's actions. Many in the West saw it as a diplomatic stunt, a way for China to look like a peacemaker without actually challenging Russia. European leaders, they weren't fooled. Brussels flatly rejected the proposals as toothless and one-sided. The plan made no demands on Russia to withdraw its forces or halt attacks, and it framed the conflict as a general misunderstanding rather than a war of aggression. EU diplomats criticized it as a smokescreen, a way for China to posture as neutral while still giving Moscow breathing room. It didn't help that China refused to even call it a war, echoing Russia's own language. To Europe, the so-called peace plan just added to the evidence that China was protecting its partner, not pushing for real peace. To add substance to this, since the war began, evidence has just kept piling up that China was helping Russia in less visible ways. Reports surfaced of Chinese companies supplying dual-use components. This includes things like semiconductors, electronics, and drone parts, which could be used for both civilian and military purposes. Recently, it's been discovered that Chinese engines are being shipped as cooling units and are being used to power Russian drones used in Ukraine. Beijing even sends explosives disguised as chemicals and various other items to aid Russia's war. The result of all of this is chaos. China's secret support of Russia is hitting Ukraine hard. The parts China is sending are helping Russia launch hundreds of deadly drone attacks every month. These drones strike deep into Ukrainian cities, destroying crucial civilian infrastructure. Russia has ramped up production of thousands of long-range drones, many powered by Chinese tech. As you might imagine, the scope of the damage is massive. Ukraine is expected to need over $500 billion to rebuild after years of bombardment. And with China quietly keeping Russia's war machine running, Ukraine's suffering keeps growing. Imagine that unshakable feeling of injustice that comes with knowing that powerful countries are helping the attacker stay strong. Going to such extreme extents makes you wonder, why is China sticking so closely to Russia? Is it just because they signed a no-limits agreement? Frankly, it's not just about friendship or trade, it's about strategy. China sees Russia as a key ally in pushing back against the US and Europe, as these nations often try to set global rules. By supporting Russia, China can challenge Western influence and build a world where it has more say. Plus, Russia's vast oil and gas reserves are a big draw. In 2024, China bought $60 billion worth of Russian energy, locking in cheap supplies to fuel its economy. This partnership also helps China stand stronger in other disputes, like over Taiwan, by showing it's not alone against the West. It's a calculated move to boost China's power on the global stage. This double game of public neutrality paired with quiet economic support has allowed China to keep its options open. For years, it has managed to maintain trade with Europe and the US, its biggest markets, while also propping up Russia, a key strategic partner. However, China has finally pushed too hard, and now Europe isn't buying the Neutrality Act anymore. The EU has been watching closely, and the evidence of China's role in helping Russia has become too hard to ignore. That's when the real action starts, with Europe deciding it's time to push back. The EU's response has been sharp and direct: sanctions. In July of 2025, the EU rolled out its 18th package of sanctions tied to Russia's war in Ukraine. But this time, it wasn't just targeting Russian companies. For the first time, the EU went after Chinese firms and banks. 2 small regional banks near China's border with Russia were blacklisted. These banks were accused of helping Russian firms bypass Western sanctions by facilitating payments and trade deals. The EU also targeted 5 Chinese companies, including ones supplying electronics and semiconductors that ended up in Russian weapon systems. This was a big deal because it marked a shift. Europe wasn't just going after Russia anymore, it was calling out China for being an enabler. The banks have not been let off easy because that's where things get really sensitive. Chinese financial institutions have been building what some call a transaction corridor with Russia. This is a way to move money between the 2 countries without relying on Western systems like SWIFT. The fear in Europe is that this corridor could become a full-blown workaround, letting Russia keep its war machine running no matter how many sanctions the West throws at it. One name that's come up is ICBC Europe, a subsidiary of the Industrial and Commercial Bank of China. There's been chatter that the ICBC has been quietly facilitating deals for sanctioned Russian firms, though it's kept a low profile to avoid scrutiny. In 2023, reports suggested the ICBC and other state-owned Chinese banks scaled back some Russian transactions to avoid losing access to the US dollar system. But smaller banks near the China-Russia border have stepped in to fill the gap. That's why the EU targeted those regional players. It's a warning shot to bigger banks like ICBC that they're being watched. The legal basis for these sanctions is straightforward. The EU says that helping a sanctioned entity like Russia during a war is complicity. EU export controls are strict, banning the sale of dual-use goods to Russia. Chinese companies were found to be violating these rules by shipping things like microchips and drone components through third countries or shell companies. In 2024, the European Commission reported that over 50% of Russia's battlefield electronics came from Chinese suppliers, either directly or through intermediaries. That's not a small number, and it's not just about a few rogue companies. It points to a broader system of support that Europe decided that it couldn't ignore. Europe's move isn't just about economics, though. It's deeply political. This isn't just about sanctions and trade, it's about standing up against deception and human suffering. And if you think stories like this deserve attention, hit like and subscribe. Your clicks help these critical truths break through the noise and reach more people. We appreciate you. By targeting Chinese banks and companies, the EU is drawing a line in the sand and saying, if you help Russia, you're part of the problem. That's a risky stance because China isn't just any country. It's the EU's second largest trading partner, with over $800 billion in trade in 2024. Going after Chinese firms could backfire, and Beijing isn't exactly thrilled about it. This is where the diplomatic fallout comes in, and it's messy. What makes this even more significant is the timing. These sanctions weren't rolled out quietly, they dropped just days before the EU-China summit. This wasn't an accident, it was a calculated message. Europe is done sending polite warnings. For Brussels to go to a high-level diplomatic meeting with Beijing while waiving fresh sanctions shows just how serious they're getting. It wasn't just posturing, it was Europe signaling that business as usual with China is over unless something changes. Europe isn't acting entirely alone either. While the EU is taking the lead on these sanctions, Washington has been silently backing the effort. US officials have pushed for tighter enforcement against Chinese firms helping Russia, and have shared intelligence with Brussels about tech components ending up on the battlefield. In fact, the US Commerce Department has already sanctioned over a dozen Chinese entities for similar reasons. Behind closed doors, there's growing transatlantic coordination to stop the leaks in the sanctions wall, with both sides realizing that pressure works best when it's synchronized. That's part of why the EU's 18th sanction package came out stronger than many expected. And as expected, from the very second that Europe announced the sanctions, China's reaction was swift and sharp. The Chinese Foreign Ministry called the EU sanctions long arm jurisdiction, a term they use to slam what they see as overreach by Western powers. They argue that the sanctions undermine global stability and unfairly punish Chinese businesses for normal trade with Russia. Beijing spokesperson Lin Qian argued that China and Russia's cooperation follows World Trade Organization rules and shouldn't be disrupted. Behind the scenes, China's been lobbying hard to soften the EU stance. The South China Morning Post reported that Chinese ambassador to the EU met with officials many times to try to get the banks off the sanctions list, but Brussels held firm. That's a sign Europe isn't backing down easily. Despite this, behind closed doors, not every EU state agrees on how hard to hit China. Countries like France and Germany with deep business ties have been cautious, but pressure from Eastern members who see Russia as an existential threat has helped shift the balance. Be that as it may, China isn't just sitting back while Europe throws punches either. With Europe starting to make a pattern out of sanctioning Chinese entities, Beijing started looking for ways to hit back, and it didn't take long. One of the first moves was targeting European brandy. China launched an investigation into whether European brandy was being sold too cheaply, and that hit French exporters hard. They're now losing around 50 million euros every month. But that's just the start. China has more ways to push back, and some of them could hurt Europe even more. One of the biggest threats is rare earth minerals. These are used to make things like magnets in electric cars and wind turbines. Europe depends heavily on China for these materials. In fact, in 2023, China supplied nearly all of Europe's rare earths, worth over $1 billion. If China decides to cut back on exports, even just a little, prices could jump fast. That would slow down Europe's plans for clean energy and electric vehicles. This isn't just a random thought either. Back in 2010, China stopped rare earth exports to Japan during a dispute, and global prices shot up nearly 30%. If they do something similar to Europe, companies like Siemens and Renault could face serious trouble. China also has power over Europe's luxury market. Chinese shoppers spend billions every year on European brands like Louis Vuitton and Gucci. In 2024 alone, they spent around 10 billion euros. If China adds new taxes or encourages people to stop buying these products, sales could drop quickly. This kind of thing has happened before. When some Western brands spoke out about China's actions in Xinjiang, Chinese social media campaigns caused a big drop in sales. H&M lost 20% of its sales in just one quarter. Europe's luxury industry supports about 1 million jobs, especially in countries like France and Italy. So if China decides to go after the sector, the impact could be huge. Another area where China could strike is medicine. Europe gets most of its active pharmaceutical ingredients from China. That's the stuff that's used to make pills and other treatments. In 2024, this market was worth around $40 billion. During the COVID-19 pandemic, China didn't stop exports, but delays in shipping showed how dependent Europe really is. If China slows down deliveries or raises prices, hospitals and pharmacies could run into problems. It's a risky move, but not impossible. After all, Chinese state media has already warned that Europe's actions could backfire and hurt its own people. So while Europe is trying to punish China for helping Russia, China isn't just taking the hit. It's already showing that it can strike back in ways that hurts Europe's economy, jobs, and even healthcare. And with tensions rising, this back and forth could get worse. Both sides have tools they can use, and neither seems ready to back down. The fight isn't just about war anymore. It's about trade, power, and who gets to call the shots in the future. What's striking is that this clash between Europe and China over Russia's war in Ukraine isn't just shaking up trade and diplomacy, it's basically rewriting the rules of how the world works together. Europe's sanctions on Chinese banks and tech firms are a bold step, but they're only the tip of the iceberg. To really understand what's at stake, we need to zoom in on the ripple effects. What's happening to the companies caught in the crossfire? How are other countries navigating this new divide? And what does this mean for the future of global stability? The companies feeling the pressure are already starting to show the cracks. Take a company like Airbus, the European aviation giant. China is a massive market for them, buying about 1 in every 5 planes they make. In 2024, Airbus sealed a $17 billion deal for 140 aircraft with Chinese airlines, a lifeline for their business. But now, with the EU's sanctions hitting Chinese firms, there's a cloud hanging over these deals. Airbus executives are worried that China could slow down aircraft orders or delay approvals. This is especially true for their assembly plant in Tianjin, which builds planes for the Chinese market. Losing even a fraction of that $17 billion deal would hurt. And it's a reminder that Europe's sanctions come with a cost. And it's not just Airbus. German car makers are sweating too. Volkswagen sells about 3 billion cars a year in China, making up a third of its global sales. In 2024, those sales brought in €80 billion for the company. But China's hinted at possible tariffs on European cars, especially big engine ones, as a countermeasure to the EU sanctions. If those tariffs hit, Volkswagen could lose hundreds of millions in revenue. BMW and Mercedes-Benz are in the same boat, with China accounting for 35% of BMW sales in 2024. These companies have spent decades building factories and partnerships in China. Now they're wondering if those investments are at risk. The German auto industry employs over 800,000 people, and any disruption in China could mean job cuts back home. That's the kind of pressure European leaders are facing as they weigh their next steps. Smaller businesses are getting squeezed too. Take a company like Infineon, a German chip maker that supplies semiconductors for cars and industrial equipment. China's a huge market for them, with 30% of their 2024 revenue, about €5 billion, coming from Chinese buyers. But the EU sanctions on Chinese tech firms, especially those supplying Russia with dual-use components, has raised fears of retaliation. If China restricts access to its market or slaps export controls on raw materials like silicon, Infineon's production lines could grind to a halt. This isn't just about one company. It's about entire supply chains that crisscross the globe, linking Europe's industries to China's resources. And that's just the economic side. Diplomatically, things are heating up too. Because of all the complexities that come with going after China, Europe is not going all in with reckless sanctions. And there's a reason for that. Europe still needs China badly. China is one of Europe's biggest trading partners, and cutting ties completely would hurt both sides. European companies sell everything from cars to luxury goods in China, and they still rely on Chinese factories for parts, materials, and finished products. So while Europe is trying to send a strong message, it's also being careful not to damage its own economy in the process. That's why you won't see Europe banning trade with China or pulling out of the Chinese market overnight. The relationship is too deep. If Europe moves too fast, it risks losing access to a huge market and facing supply shortages at home. That's not a risk most European leaders are willing to take. Still, Europe knows it can't keep relying on China the way it has. The war in Ukraine, tensions over Taiwan, and now China's support for Russia have made it clear that depending too much on one country is dangerous. So Europe is starting to shift its strategy. Instead of cutting ties, it's trying to de-risk. That means reducing its dependence on China without breaking off the relationship completely. One way Europe is doing this is by diversifying its supply chains. That means finding new countries to trade with and new places to get materials and products. For example, some European companies are moving production to countries like Vietnam, India, and Mexico. Others are investing more in local manufacturing to avoid relying on overseas suppliers. The goal is to make sure that if something goes wrong with China, like a political dispute or a trade war, Europe won't be left scrambling. The shift isn't easy though, and it won't happen overnight. China still offers cheap labor, massive factories, and a huge consumer base. But Europe is starting to think long-term. Leaders are talking more about economic security and resilience. They want to make sure Europe can stand on its own if global tensions rise. That's why you're seeing new trade deals, more investment in local industries, and a push to build stronger ties with countries that share Europe's values. So while Europe is pushing back against China's support for Russia, it's also walking a fine line. It wants to stand up for its principles without hurting its own economy. That's why the strategy isn't about cutting off China, it's about being smarter, safer, and more prepared for whatever comes next. What's emerging from all of this is a world splitting into new blocks. On one side, you've got the West, tightening its coordination on sanctions and trade restrictions. This isn't just about trade or sanctions to them, it's about power. On the other hand, China and Russia are building a parallel system, one that doesn't rely on Western tech or finance. Their trade is projected to reach $300 billion in 2025, and they're using their own currencies for 90% of transactions, bypassing the US dollar. That's a big deal, because the dollar's dominance gives the West leverage to enforce sanctions. If China and Russia create a viable alternative, it could weaken that power. This split between these two major blocs raises a big question. Is trade becoming a permanent weapon? The EU's sanctions on Chinese banks and firms are a step towards what some called weaponized interdependence. This is where economic ties are used to punish or control. With everything going on, it's hard not to argue that they aren't. But as the world splits, countries like India, tied to both East and West, are now being pulled in both directions. It's a part of BRICS and boosted trade with China to $136 billion in 2024. But it also relies on Western investment and tech. India's been buying cheap Russian oil, about 1.8 million barrels a day in 2024, up from 0.2 million before the war, all while keeping ties with the EU. Recently, however, this has become a major talking point, as President Donald Trump has threatened to impose tariffs on nations that buy Russian oil. India has been called out, and U.S. Senator Lindsey Graham has said specifically that the U.S. will tear the hell out of you and we're going to crush your economy. India's response to all of this has been that the nation will do what it needs to do for its people, given that energy security is its highest priority. These are ripples in the water, and things like a deeper EU-China rift could force them to pick a side, something they've avoided so far. Turkey is another wild card. It's a NATO member, but has kept trade flowing with both Russia and China. In 2024, Turkey's exports to Russia hit $7 billion, including machinery that often ends up in military use. At the same time, Turkey has deepened ties with China, with various deals happening between the two nations. Ankara is playing both sides, but the EU sanctions on Chinese firms puts pressure on Turkey to tighten its own export controls. If Turkey doesn't comply, it risks EU tariffs, which would hurt since 40% of its exports, about $90 billion in 2024, go to Europe. Yet, siding with the EU could strain its growing partnership with China, a key investor in Turkish infrastructure. African nations are also caught in the middle. Many rely on Chinese loans and infrastructure, with China investing $30 billion in Africa in 2024, building roads and ports. But Europe's a major aid donor, giving $20 billion annually to sub-Saharan Africa. Countries like Nigeria and Kenya don't want to alienate either side. Nigeria, for example, exports $2 billion in oil to Europe, but signed a $5 billion deal with China for a new port in 2025. If the EU-China tensions escalate, these countries might have to choose between Chinese investment and European aid. This is a decision that could reshape their economies. This jockeying for position is creating a world where trust is eroding fast. The EU sanctions are pushing countries to rethink their alliances, and the ripple effects could last for decades. Energy markets are another flashpoint to consider in this overall equation. Europe's already struggling after slashing Russian gas imports by 70% in 2024. Now it's turning to places like Qatar and the US for liquefied natural gas, which costs €50 billion more than Russian gas did in 2021. If China retaliates against EU sanctions by disrupting trade routes, like slowing shipments through the South China Sea, where 30% of Europe's imports pass, it could drive energy and shipping costs even higher. In early 2025, freight rates for containers from Asia to Europe jumped 15% due to geopolitical tensions. Another spike would hit European consumers, already dealing with 5.3% inflation in Germany. So where does this all lead? Well, what we're seeing is that Europe's not just targeting Russia anymore. It's going after the countries enabling Russia's war. China's deep ties with Moscow have been put in the crosshair, and the consequences are piling up. EU-China relations, once built on trade and cooperation, are cooling fast. Recently, just before a planned EU-China summit in Beijing, tensions were already high. China's warning of retaliation didn't stop the EU from moving forward with sanctions, showing a new willingness to take risks. But this isn't a one-sided fight. China's got leverage, and it's not afraid to use it. Looking further out, this standoff could lock in a new kind of global order. The West's push to isolate Russia and pressure China is creating a fault line. If China doubles down on its Russia partnership, it risks losing access to Europe's multi-billion-dollar market. But if it pulls back, it could weaken its strategic hand against the West. Beijing's already testing the waters, boosting trade with non-Western countries. This pivot could give China a buffer, but it's not a full replacement for Europe's purchasing power. Europe's got its own tough choices. Keeping up the sanctions means risking economic pain at home, but easing off could signal weakness. The EU's trying to thread the needle by diversifying supply chains and boosting domestic production. But these projects take years. And in the meantime, Europe's exposed. If China retaliates with export curbs, the EU's green goals, cutting emissions by 55% by 2030, could slip further out of reach. The Ukraine war keeps fueling this divide. In its 4th year, it's not just a regional conflict. It's a catalyst for global realignment. The EU sanctions on China are a bet that pressure will force Beijing to rethink its support for Russia. But China's betting it can outlast the West, leaning on BRICS and its own economic clout. The outcome hinges on who can absorb more pain. Europe's economy, with $18 trillion in GDP, is strong, but vulnerable to energy and trade shocks. China's $17 trillion economy is growing fast, but relies on exports to the West. As Europe tightens the screw, China faces a choice. It can double down on its alliance with Russia, betting that the West will blink first. Or it can pull back, scale down its support for Moscow, and try to save its trade ties with Europe, which accounted for 14% of China's exports in 2024. That's a tough call for Beijing, which sees Russia as a key partner in challenging Western dominance. For now, the world's watching to see who blinks first in this high-stakes standoff. As the war drags on and alliances harden, the question isn't just who blinks first, but what the world will look like when they finally do.